Good afternoon, ladies and gentlemen. Welcome to the BELVOIR Group PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Simply type in your question at any time and press send. Given the attendance on today's call, the company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions and publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, we'd like to submit the following poll, and as usual, I'm sure the company will be most grateful for your participation. And I'd now like to hand over to Dorian Gonzalez, CEO. Good afternoon.
Hi there, Mark. Thank you very much for that kind of introduction, and hello to everybody. Some of you may have, I'm sure you've listened to our presentations in the past, and we're going to stick to a sort of tried and tested format where I cover the first third of the presentation and talk about the key highlights and giving you an introduction to the business, or a reintroduction to the business. Louise then covers, Louise, my CFO, then covers the middle section to talk about the sort of finances and the numbers, and then I'll come back and do the final third of the presentation, which is geared around the three markets that we operate in, that's sales, lettings and mortgages, and also I'll share some sort of operational detail with you as well in the last third. Then I'll wrap up and hopefully we'll have time to answer everybody's questions. So first of all, an introduction to both myself and Louise. I've been in the property sector for 25 years, 18 full years with BELVOIR. Just coming into my 19th year. Louise, 21 years experience on the board of AIM listed companies, 9 years with BELVOIR. And when I sort of think back to what the business looked like 9 years ago, at that moment in time, we had just one brand. We hadn't long listed. You know, in terms of growth, profit growth, and in terms of our sort of footprint across the country, the business now is almost completely different to how it looked 9 years ago. We both have shares in the business, as you can see, and we both have share options by means of LTIPs going forward. And again, they're on the screen. Our ticker is BLV. We floated in 2012, and I was the CEO at the time of the float. Market cap is a touch higher. The market's reacted reasonably well today to the results announcement, so it's nudged up a little bit. I think it's around sort of 84 million. We've had 26 years of unbroken profit growth. That's profit after tax, and I'm sure that lots of our holders will be very pleased to see that we have increased our dividend by 25%, our H1 dividend to 5p from 4p, and that's paid sort of end of October. We've also said in our statement that we are comfortably in line as far as H1 is concerned, and that we are comfortably in line as far as the full year is concerned. So, you know, hopefully you'll see as we sort of run through the presentation, hopefully you'll see that, you know, we as a business, we are outperforming the market in all three of the sectors where we operate. That's sales, lettings and mortgages, and I'll sort of try to explain why that is as the presentation unfolds. Okay, so a reminder on the business itself. So we've acquired 6 property businesses since 2015. The first one was Newton Fallowell. So we started with the BELVOIR brand, entirely franchised business at the time. We acquired Newton Fallowell in 2015, Northwood in 2016, Lavelle 2020, Humphreys 2021, and the Mr. and Mrs. Clark in 2022. So these are the 6 property acquisitions that we have made. BELVOIR was the original brand. There was one very small brand that we acquired in 2015, Good Charles, that we subsumed into Newton Fallowell. So we have made 6 acquisitions, but BELVOIR was the first brand. The reason for the sort of multi-brand strategy is that, you know, we feel that we have become very good at franchising. Franchising is quite a niche industry. So we are, you know, we started out as franchisors who then decided to operate within the letting sector, not as letting agents who then decided to be franchisors, if that makes sense. And if you can operate one franchise brand, we've proven that you can operate more than one, whether it's 2, 3, 4, 5, 6 or more. The brands are different somewhat. They all operate in property, but BELVOIR and Northwood are primarily residential lettings agents, so they look after properties on behalf of landlords. So 90% of the revenue through Belvoir and Northwood franchisees comes from lettings, and just 10% comes from estate agency, whereas Lavelle and Newton Fallowell are based in the East Midlands, where we are sitting now. So the majority of the property sales that we are generating are generally happening sort of in the East Midlands and Lincolnshire area. Nicholas Humphreys is a student lettings business with about sort of 6,000 to 7,000 student beds, and the Mr. and Mrs. Clark is a small personal agent home run franchise. It's our first foray into sort of home run franchise models. It's a low cost entry point and a relatively new acquisition for us. There are the 6 property brands that comprise the Belvoir Group. On the right hand side of the slide, in 2017, we decided to expand our product set into financial services, i.e. mortgages. We've got lots of transactions happening within the business, some of which have mortgage opportunities attached to them. As a franchisor, we also have to continually, come up with new initiatives to keep our franchisees engaged and keep them excited, and to give them a way to grow their business long term. And financial services was our decided route back in 2017. If you've been following our story, we have also made 6 acquisitions on the financial services side since 2017, 2 of which have happened in the last 3 months, quite small ones. We first acquired a business with just 30 mortgage advisors back in 2017, run by a lady called Michelle Brooke. Michelle's still with us. She sits on the board, and she's overseen the growth that we've experienced on financial services. It's a complementary product. It's similar to franchising in that most of our advisors are self-employed, and I said a few minutes ago that we're outperforming the market in sales, lettings and mortgages, and to me, if you said, well, look, Darren, what do you pin that on? I personally think it's due to the self-employed element of our business model. So across all of the property franchise brands that you can see on the screen, all bar a couple that we own and we operate, the rest are run by franchisees. It's their business, it's their future, it's their profit. We take a cut of the revenue that's generated in return for providing products and services, but ultimately it's the franchisee's business, and they operate within one of our brands, and that gives the business huge strength. We saw that during COVID, where we performed extremely well. We performed well after the credit crunch all those years ago, and we are performing well again in a market where property prices are falling moderately and transaction numbers have dropped by about 20% actually on the estate agency side, but I'll come on to that later on. So that's really just a reminder of the business itself. We've got 335 franchisees operating from sort of shops and offices, so 335 locations on the property side, and on the mortgage side we've got 321 advisors, giving a total of 487 locations. We have in some locations more than one advisor, if you're trying to add the numbers up there, but that's great. If you can push me on, Louise, that'd be great. Thank you. Just to give you an idea, I mentioned that we have acquired 2 small mortgage businesses in the last few weeks. One of them completed on the 24th of August, and the other completed on the 6th of June. And we just issued 1 RNS to cover both of these businesses a week or so ago. So they're very similar. BMA Bristol was and still is operating as a mortgage advice bureau business. That's the front brand. As I'm sure you're aware, we operate under license to Mortgage Advice Bureau. So we contract with Mortgage Advice Bureau and we get access to their website, to mortgage lenders. They look after our compliance and they do a whole host of things in return for a cut of the commission, that is earned from the lender. In these 2 small businesses, they were previously operating as MAB. They're now operating under our banner, so we now support them, but they'll continue to trade as Mortgage Advice Bureau. Each one has a network of self-employed mortgage advisors. One has 20, the other has 21. The consideration across these 2 businesses is about 3 million. The profit contribute, in fact, the consideration, apologies, is about 2 million, just over. It was 1 million net of cash for BMA Bristol, and it's 1 million net of cash for MAB Southwest. In terms of revenue, that's just over 3 million, but consideration about 2 million. Profit contribution in a full year will be around 600,000. So quite an attractive multiple. We've been maybe opportunistic on one hand, but ultimately this year has thrown up a few opportunities that we are just making the most of. On the other side of the slide, assisted acquisitions. If you haven't seen these before, this is where we help a franchisee on the property side to find and acquire one of their competitors. So it's mainly the acquisition of small lettings businesses. We've helped franchisees acquire 139 of these small businesses. That sounds like an exhausting amount, actually. It's 139 small businesses over since 2014. It's very profitable for a franchisee to do this. It's very profitable for us because we get a percentage of the revenue that is acquired by the franchisee. And the chart at the top just shows the sort of the growth. So we had 2 good years in 2018 and 19, and in each year, these assisted acquisitions contributed about 600,000 of management service fee, MSF. Fell off a cliff during 2020 and 2021 due to COVID, and then we gradually sort of built back up. And the good news is that at this point in the year, up until the end of August, we have already completed on more acquisitions than we did in the full year last year. So we're expecting to have a reasonably good year on franchisee acquisitions. This is helping us to continually grow managed book of lettings, which is recurring, and we are now managing about 75,000 residential properties, 2,000 of which have come from this strategy in H1 this year. We have further deals in the pipeline, franchisee deals. We've got 1 million of revenue of deals with solicitors, and we've got another 4.9 million of franchisee revenue under review. So these are opportunities that haven't quite become deals yet, and I'll keep you updated on that as the year progresses. So just a few key highlights before I pass across to Louise. Very pleased to say revenue is up 3% to 15.9 million. Profit before tax is up to 4.4 million. That's up 10%. Net cash. So if you followed our story for the last few years, you may remember that up until the end of last year, we were carrying debt mainly for the acquisition of the property networks that we have bought. We finished the year net cash. We are still net cash, and both of the acquisitions that have completed in the last few weeks have been bought with cash. I mentioned the dividend earlier, so it's a 25% increase that has been generally well received. We operate in 487 locations in total, which is up 3%, and we're now at 321 mortgage advisors at this point after acquiring 2 small businesses. House sales, which I'll give you some more detail around this later on. House sales are down. So in terms of numbers of house sales, we are 15% down. So we have exchanged on 4,177. That doesn't sort of translate to a loss of 15% of estate agency revenue, but I'll explain that a little bit later on. Managed properties I've mentioned at 75,000, which is plus up 2% on the same period last year. So, in general terms, metrics are up. They're certainly up against the backdrop of a challenging market on house sales. So house sales are down, but ultimately so is the market. And I'll talk in more detail shortly. Over to Louise.
Okay, hello. Sorry, I was just trying to click on the mute button and move the slides on at the same time. Revenue in the first half was up 3%, as Dorian said. On the property side, in the property division, we saw revenue at 7.3 million, which was actually down from 7.7. So just to explain that movement downwards, we actually franchised out 2 of our corporate owned offices when we acquired the Nicholas Humphreys network a couple of years ago. It came with 3 corporate owned offices and about 7 franchise offices. So we managed to franchise out the Burton office back in September and the Derby office in February. So that gave a movement that effectively converted the direct fee income of 600,000 into a percentage of revenue being our management service fee of 100,000. And I'll cover that in a little bit more detail shortly. On the management service fee side, that's our key recurring revenue from franchisees. On the letting side, it was down. It was up 8%, of which the like-for-like growth was 6%, and the sales revenue, and not surprisingly was down. That was down 9%. And if we looked at it on a like-for-like basis, it would have been down 15%. Financial services was up 11% to 8.6 million, and the acquisitions that we've done actually added 19% of growth in the first half. And when I talk about the acquisitions, if we look back to last year, we acquired the network Time right at the end of May last year. So this year we had effectively 5 extra months. And then this year, at the beginning of June, we acquired the business down in Bristol, BMA Bristol. And so we've had sort of about 3 weeks worth of trading from that business. So that accounted for growth of 19%. Meanwhile, the like-for-like financial services business went down 8%. But when you compare that to a 26% fall in the UK gross mortgage lending in that period, I think we'd consider that quite a good result. On the gross profit side, that was at 9.3 million, down from 9.4. Basically, the property division was down 300,000 and the financial services was up 200,000. The overall gross profit margin is 58%, and that's down from 61% for the same period last year, and that reflects the increasing proportion of revenue from financial services. So basically, revenue on the property side, 100% of revenue falls through into gross profit, whereas on the financial services side, we see quite a significant pay away of about 75% going to the commission to the advisors, and also fees payable for the leads from agencies. So there's quite a large pay away. The financial services itself, their profit margin, gross profit margin, was actually 23% compared to 22% last year. And if we were to look at it over the full year, we'd project it to be at about 25%. And this is because we get quite a large override from Mortgage Advice Bureau at the end of the year, which we don't account for until the end of the year, when we know what it actually will be, because it has a certain thresholds. Net profit before tax was up 10%. Net profit after tax was up 4%, and that was despite the increase in tax rate in April this year. And as Dorian mentioned, we'd increased the dividend, which really reflects the strong cash generation now that we're net cash and increasing profitability. So just moving on to the P&L in a little bit more detail. I'll give you a little bit more detail around the gross profit, and the reason we do it at the gross profit line, because this is a more appropriate comparison between the financial services division and the property division. So the franchising out the 2 Nicholas Humphreys offices, as I said, it reduced the gross income from the corporate offices by 600,000, but it added 100,000 in MSF, giving us a net impact of 500,000 in gross profit. But if we look on under the administration cost side, we actually reduced our overheads by 500,000. So the net effect for the business was nothing at all, and it was absolutely in line with our franchising strategy. On the management service fee side, it was up 4% to 5.5 million. We saw MSF from lettings up by 300,000, offsetting 100,000 decrease in MSF from sales. The like-for-like growth on the letting side was 6%, and that compares to the UK rental index of about 5.5, 5.2. And the like-for-like decrease in sales of 15% compares to an 18% drop-off in UK property transactions. On the financial services side, gross profit was up 13% to 2 million. The acquired FS businesses added 300,000, and the underlying businesses were broadly the same. So the gross margin ratio is something that we always report on. Lettings was at 58%, down from 60% in the first half of last year. And we can see there that sales has dropped down to 15%, whilst financial services is up to 21%. On the admin costs, overall, they were down 400,000 to 5 million. That was a 7% decrease. As I said, the franchising out those 2 corporate offices reduced costs by 500,000. We also spent £200,000 less on corporate professional fees associated with acquisitions. So that was a saving this year. Slightly higher share-based payment charge added 100,000. and meanwhile the acquired businesses added 200,000. And when we call those into account, the underlying overheads remained broadly the same. As we can see there, profit before tax up to 4.4 million and the earnings per share up to 9 pence per share. So this slide is a slightly different representation to one that we've shared at the full year results, at the prelims, looking at how the red being lettings, the green being sales, and the blue being financial services. So this is looking at the gross profit contribution from each of those income streams. And down the right hand side here, you can see the milestones of where we've made various acquisitions. So back in 2012, we were purely one brand, Belvoir, and we only did lettings. We started to do a trial on sales and introduced a little bit of sales in 2013. That started to build up mostly in 2015 when we acquired Newton Fallowell. That came with a little bit of financial services, but that started to build up in earnest when we acquired Brook Financial Services in 2017. And so we've gone on with our last two acquisitions in 2023, which haven't really affected, one hasn't affected the first half numbers at all, and the other one, by a very relatively small amount. So over the period since 2017 to date, with actually financial services has actually made a contribution of 17.7 million in gross profit. And that's against a total investment, including the last two acquisitions, of 12.2 million. But obviously, we've got all the upside from those acquisitions still to come. So if we move forward and have a look at the balance sheet, on the balance sheet, we can see that we've got the acquisition of BMA Bristol for 1.1 million, and netted up with the sale of Nicholas Humphreys Derby to the franchise, to the branch manager to franchise it. One of the areas I try to explain is what we call the unearned indemnity commission. The balances that are affected by unearned indemnity commission, that being when we sell a life protection policy under financial services, we earn all the commission up front. But it could, if the client cancels within 4 years, there's a clawback on a straight line basis. So Mortgage Advice Bureau themselves, they retain some of our commission in a bank account with our name on it. They're currently holding 2.2 million of our funds. That's because they're the first line with the unearned indemnity commission. It's called from them first, and then they would recover it from us. We recognise that we have a liability of 2.2 million, but we can recover 700,000 from our advisors for where they have responsibility for that themselves. So that makes up those three balances. We have, at the half year, we had net cash of 400,000. That compares to net debt at the end of June last year of 2.5 million. At the end of the year, we had our bank loans were still 2 million, which we settled in March. But we do actually have a £2 million overdraft facility in place to give us a little bit of headroom should there be any short-term requirements. And on Friday, 1st of September, the bank balance was £500,000. Just move on and talk about the cash flow. Still highly cash generative, 91% of EBITDA converting to cash. You'll notice there that the tax payment in the first half of this year was much higher than it was last year. This year's is fairly normal. It's last year we had there were some share options that were exercised in 2021 that gave rise to a tax relief against the first half payment of corporation tax in 2022. So that's why last year's was quite a lot lower. On the investing activity side, we invested £1 million in BMA Bristol net of cash acquired. We lent £500,000 to the franchisee taking on Nicholas Humphreys, and you can see that we continue to provide financial support to franchisees under the assisted acquisitions programme. And as Dorian covered earlier, we've seen a lot more activity on that front, and hence the lending has upped accordingly. On the financing side, we repaid the loan of 2 million in March, and we had a 5 pence dividend per share paid as a final dividend for 2022, payable in May. That was a total cost of 1.9 million. If I just give a little bit of an update on our ESG strategy, we had set up our 5-pillar strategy last year, and this year we've been spending time formulating our decarbonisation strategy. We've created a bespoke emissions modelling tool which estimates changes in our carbon footprint up to 2030. We started to implement some of our specific policies. For example, as cars, our company cars come up for renewal, they're being replaced with electric cars, and we're installing electric charging stations in our central office car park. Whilst we're working towards decarbonisation, we intend to offset our current usage against certain projects in the UK and abroad. Moving away from the sustainability issues, on other aspects of ESG, we've conducted 98 training courses to nurture talent. That's both for franchisees and for our staff. And we've carried out 172 audits of our franchisee businesses to ensure the highest professional standards. So on that note, I shall pass you back to Dorian.
Great, thanks, Louise. So as I said at the beginning, the final third of the presentation really centres around the operation itself, which is this slide, and the next handful of slides are really to cover the property market and also the financial services sector, and hopefully some of these slides will answer some of the questions that we've had come through. If not, we'll sort of tackle the questions at the end. So first of all, property locations is pretty stable at 335. We're not reliant on opening new locations to drive growth across the franchise network. I just wanted to point that out. And just to give you an example of that, in the first half of this year, 20 franchisees exceeded revenue of 0.5 million. So we've got 20 franchisees now online to achieve $1 million of revenue or more from sort of single locations. The average revenue across all of our franchisees, our property franchisees, is about 320,000 a year. So you can see that if you're a property franchisee, you haven't got to open in 5 locations to grow your business. You can stay in one location, and in theory, if your territory is big enough, you can grow to, a turnover of $1 million from one location, if not slightly more than that. So point being, we're working with our existing franchisees to help them grow the business. It's much more risky to sort of cold start and open from scratch, and that was something that we pulled away from a number of years ago. So on the operational side, the average MSF, so I just said that the average revenue per franchise is about 320,000. It was a touch less than that in the first half of this year. But I suspect they'll have a slightly better second half. But in general terms, it's about 320,000 a year. The average MSF that we generated per franchisee in H1 was 16,800. That's for the half year. The MSF rates that we charge are between sort of 10 and 12%, depending on which franchise network the franchisee is in. Number of mortgages, I touched on this earlier. So we arranged 10,252 mortgages in the first half, which is up 6%. An average group income per advisor. So on the basis that the overall mortgage market fell back by about 28% in H1, our average income per advisor remained exactly stable, which is helpful. That just illustrates the point that I made earlier in the presentation, that when you've got self-employed individuals, no matter what's happening with the market around them, if the market slows down or changes or becomes tougher for any reason, they sort of work harder and work smarter because they don't want their income levels to drop. I think with greater respect, if it was a sort of corporate managed network with branch managers, for example, or employed advisors, when things get tough, it's fairly easy for a staff member to leave and go and do something else. It's very different if you are running your own business. So we're underpinned by that self-employed element. Across the property division, we opened in 2 new territories, both by existing franchisees. We helped 10 franchisees to sell the business and move on. Generally, that's at the point of retirement. Not always, but in general terms. And we've got about another 10 resales in a pipeline. I suspect we'll finish the year similar to last year, with maybe 20 to 25 franchises resold throughout the year. I've already mentioned the portfolio. The number of house sales was down 15% to 4177, and that compares to an 18% reduction in overall UK house transactions. And I've got a slide on the sales market next. Lettings to sales ratio. So if you move financial services to one side and just look at our property revenue, 80% of our property revenue is recurring. It comes from residential lettings, and 20% of our property revenue comes from estate agency. We've got 20 franchisees heading for $1 million of revenue this year, and 64 franchisees now run 2 or more offices, with 23 franchisees having 3 or more offices. The highest number of offices run by a single franchisee at present is 6. Across the financial services division, we're at 321 advisors. You can see the average group income per advisor. 10% of the mortgages written in the first half of the year were for buy-to-let, which is down. It was 16% in H1 2022. I think landlords have had very cheap lending for a long period, and I suspect that some landlords, I'm one of them, are just reducing their gearing so that they're not particularly affected then by higher sort of borrowing costs. About half of landlords have got a mortgage and about half of landlords haven't. That's the sort of split. The ratio of purchase mortgages to remortgages last year in H1 was 60-40. In H1 this year, you won't be surprised to see that shifted to about 50-50. So the number of purchase mortgages has come down, the number of remortgages has gone up, as people actively want to do something to when they're falling off the end of previous fixed rates on which were very low. The average case size per mortgage that we're writing is 1,249, and that's slightly down on last year, but that reflects the higher proportion of remortgages, which tend to be slightly less profitable. Lending from group mortgages was at 2 billion in the first half of this year. It was 1.5 billion in the first half of last year. So that's just an overview on some of the operational detail. Now I've had a few questions on the rental market, unsurprisingly, so I'll run through this slide, then I might grab 1 or 2 of the questions and then move on to estate agencies. So first of all, what is the slide showing? Well, the thick blue line at the bottom shows rental growth across all tenancies. So that's new tenancies and its tenancies where the tenant hasn't changed, so existing tenancies. That's the thick blue line, and that's running at about 5%, up from 2% back in March 2017, which is where the graph starts. The thick red line is rental growth on new lets. So if you are looking to rent a property today, chances are you will be up against maybe 10 or 15 other people who also want to rent that same property. That's giving rise to an uplift in rental inflation on new lets. And rental inflation, interestingly, is running at double digits in most regions. And in fact, in Scotland, over the last 12 months, it's running at 15% inflation on new tenancies. When you apply when you look at the whole of the rental market, including tenants where they haven't changed property, it's much more, it's much lower than that. It's sort of circa 5%, and that's tracked by ONS. And then the grey line just shows earnings growth. So you can see that sort of now sits in the middle of all tenancies, which is the bottom, and rental growth on new lets at the top. It kind of sits in between that. Whereas if you look back at the start of the graph at March 2017, wage growth was just a touch higher than the other two lines. This isn't in the slide deck, but from my point of view, I mean, the reason for this is that demand for rental properties is 57% higher now compared with the average over the last 5 years. It is very, very high for lots of different reasons. The supply of rental properties, i.e. the number of properties available to rent today, is 27% lower than the 5-year average. Now, that shouldn't be confused with the size of the private rented sector. So the size of the sector, i.e. the number of rental properties with people living in them, is about the same size. There's anecdotal suggestions that some of the landlords with properties may have sold over the last year or two. That hasn't been confirmed in any data yet, but it will be confirmed in the English Housing Survey towards the end of the year. I suspect that some landlords have sold off for various reasons in the last year or so. If you look at the last English Housing Survey, which is 21 to 22, it runs financial year, the size of the private rented sector had grown over that period by about 170,000 units. I suspect it's fallen back by a similar amount when we see the new English Housing Survey in December. So demand is very strong. Supply in terms of available properties is very low, and as I mentioned, tenants are competing with maybe 10 or 15 other people to secure a property. Now, there isn't anything that suggests that is going to change in the short to medium term. Government are sort of making slightly kinder noises towards landlords, but that hasn't. That's Michael Gove, but that hasn't translated into sort of any action. If rental inflation is to be curbed by any measures, really what needs to happen is that government needs to be more friendly with landlords, possibly sort of wind back on some of the disincentives that have been introduced over the last 6 or 7 years, and encourage more landlords into the sector. I'd suggest if that doesn't happen, I think there'll be a fair few cross renters, and there are 13 million people renting in the run up to the election if rental inflation continues to run at these levels. But as I say, from my perspective, I can't see anything that will have, bar affordability, there isn't anything that I can see that will curb that or increase supply. Somebody asked on the questions, is build to rent making any difference? No, is the short answer. The rate of growth of build to rent has slowed in the first half of this year, and there are around 250,000 build to rent units either complete, and it's a significantly smaller proportion of that have been completed, either complete or in the pipeline. The size of the private rented sector in England is just shy of 5 million, so it's a very small part of the sector. And over the last few years, we've seen population increase to the tune of, in the last few years, 2 million. Population is forecast to increase by 3 million over the next 10 years. And the private rented sector just isn't keeping up in terms of growth with population pressures and other pressures. And interestingly, what we've seen in the past when property prices sort of fall back is that normally the private rented sector takes the slack. So we've got a counter-cyclical side to the business. But actually what's happening now, if fewer people are buying properties, and 18%, there have been 18% fewer transactions in H1 compared with last year. So if fewer people are buying, more people are therefore requiring rental properties because people need to live somewhere in the intervening period. So that's putting even more pressure on the rental side. We are a big letting agent. We manage a lot of properties. We continually grow our managed portfolio. And another question that we've had is, will small landlords be sort of pushed out, over a period of time? The average landlord in the private rented sector owns 1.8 properties, and no, there isn't really a shift away from small landlords to larger landlords. That isn't something that's happening. Rightmove did allude to the fact that they're dealing with they're seeing more sort of corporate landlords, but that's due to tax treatment. Landlords can incorporate at any point. It doesn't mean that they're a bigger landlord. It just means that they're taking their portfolio of 5 properties and incorporated. Therefore, they are by some commentators being called professional landlords. I would question that. I just think they're using a different vehicle because of for tax purposes. So hopefully that just gives you a steer on the private rented sector, and I'll run through some more questions on that shortly. If we move on to the next slide, Louise, we have residential property sales. In many ways, it's easy to sort of see what's been happening with property sales. So I'll touch on house prices first of all. House price is the most pessimistic index of house prices, and there are sort of 4 or 5 different high-profile indexes. Rightmove, Zoopla, ONS, Nationwide, Halifax, just to name a few. You've got sort of Nationwide at the most pessimistic end, saying that property prices have fallen by 3.8%. The most optimistic actually is sort of ONS. They track sale completions which are 5 months out of date, if that makes sense, because a completion is based on a property sale that happened 5 months before. So they're, in terms of their index, they're saying that property prices are 1.7% higher than they were compared with their previous 12 months in their index. So somewhere between plus 1 point something and minus 3.8% is where the indexes show. And the bottom line is, I think property prices will probably fall even further. Not too much. I think they've been very resilient. But I suspect that we've got a little bit more to come on that side. I also suspect that transaction numbers will remain about the same, sort of minus 20% up until the end of the year. At the start of this year, we forecast that the UK would see 20% fewer property transactions, and we took 20%. You may remember that we issued we changed our numbers in January to reflect that. We said that we hand on heart, we felt that we would see across the whole sector 20% fewer transactions, and that's exactly what's being borne out in the numbers. So what the graph's showing is housing transactions in blue versus, well, on the same chart, we've got the house price index. So you can see the sort of pattern of housing transactions. In the first half of this year, the UK saw about 490,000 sales complete. That was sort of versus almost 600,000 in the first half of last year. That's the it's 482,000. That's the sort of changing number. Good news is, so on the back of that market, our MSF from the state agency is down just 9%, which we think, against a market that's sort of 18% down, is actually a pretty good result. Okay, onto the sort of mortgage market. Now, this is the graph is showing you the UK mortgage market. It's not our mortgage lending numbers. We used this slide last time around, so we're using it again. And it just shows that house purchases in dark blue, house transactions in grey at the top, and then you've got remortgages in red. So it just illustrates the fact that transaction numbers have fallen, and also that there is a change in mix between house purchase mortgages and remortgages. So gross UK mortgage lending in H1 this year was down 26%. Our performance against that is plus 11%, and that's by means of acquisition. We haven't yet seen the upside of the 2 acquisitions that we've completed on the last few weeks. That will come in H2. I think just a few sort of points. I've mentioned that most of our advisors are self-employed, therefore they work harder in a more difficult market. We also have a strong client database, so all of the acquisitions that we've made have come with many years of sort of clients that can be approached for remortgage reasons. I also think that there is a much higher demand for bespoke advice now from an intermediary compared with 2 years ago. If you fell off a sort of 2% fixed rate 2 years ago, you may have just called your bank and said, look, just can you sort me a deal, or can you just lead me on the sort of the current rate. Whereas now, I think that most clients are shopping around to see what deals are available to them for obvious reasons, because rates are going up. I'm sure you've got your own thoughts, but we tend to feel that rates, the bank rate may top out towards the end of the year. If that does happen, that will give an impetus not just to the house sales market, but also to the mortgage market too. So we've been through, on the mortgage side, it actually has been difficult really for the last sort of 9 to 12 months following the mini budget. But as you can see, we've continued to grow the business regardless. That kind of brings me to a wrap up really before I move on to sort of questions. So, why invest? We have a proven multi-brand franchise model. Franchising to me is a fantastic method of supporting people who want to work for themselves, but they don't want to have the hassle and the grief and the risk of designing an entire business model on their own. So they can join our model, use our systems, use our training, use our support, use our acquisition support, use our technical knowledge to grow a small business with through an established brand. So a proven multi-brand franchise network, and we've got a history of a strong financial growth, so 26 years of unbroken profit after tax. although I appreciate you haven't met them, we've got a very strong and stable team of directors and managers who sit beneath the board, who run each part of the business, some of whom have been with me for 15 or 16 years. These are very, very skilled people. We've got a high degree of recurring revenue, so 58% of our gross profit comes from recurring lettings, 21% comes from financial services. Although it's not on this slide, 15% of our gross profit comes from estate agency, so the smallest part comes from property sales. And as I said at the very, very beginning, we've made 12 corporate acquisitions since 2015, 6 on the property side, 6 on the financial services side, and we remain very acquisitive. And we've got a good plan for the future, and we'll continue to deliver results. What we have said in our release is that we are comfortably in line, obviously, with the first half, and we're also comfortably in line for the full year. We have already said that to the market, just to give you the best reassurance that we can. So what I'm going to do now is I'm going to run through some of the questions. If I read them out, some I'll pass across to Louise, and some I'll tackle. So I think I'll do we've had a couple of sort of pre-submitted questions. So I think it's only fair to deal with those first of all. So the first question: given the UK lettings industry consolidating in previous years and expecting to do so into the future, what are our thoughts on the use of excess cash in an environment where there are not adequate acquisitions to deploy capital? It's a good question, and I think that first of all, assisted acquisitions are the most profitable thing that we can do. That's where we help a franchisee to grow their revenue by means of acquisition. It's very profitable because we get a cut of that revenue with very little cost to set against it. So that is number one in terms of our choice. I think we have also instigated, in terms of use of capital, we have undergone a small share buyback in the last few months, which you may have seen documented by means of RNSs. We may consider special dividend, I guess. That's something we may consider, but ultimately we have just increased our dividend, which has gone down very well, which some of the comments support that. So I guess corporate acquisitions fit, alongside really franchisee acquisitions, that if we've got targets and we can acquire businesses at 3 to 4 times multiple, like the 2 that we've just done, why wouldn't we? I guess is my question back. But clearly it depends on what opportunities we have going forward. We are very cash generative, and we are, as a board, considering various options for use of cash. That was the first question. Let's have a look. As a follow-up question, the same person said, what kind of metrics do we look at when evaluating an acquisition? Louise, do you want to mention, this is a corporate acquisition. Do you want to just go for that one?
Yeah, we certainly look for geographical fit, and whether it's obviously whether they're going to be accretive to the business, whether, like on the financial services side, how they dovetail with our financial services business. Certainly on the financial services side, we favour networks that are made up of self-employed advisors as opposed to employed advisors. In fact, I'd go as far as saying we would actively avoid any where they're employed advisors. And on the property side, obviously, we're looking at the franchise element, which is why we acquired Nicholas Humphreys and Lavelle. They were both they ticked the geographic box in terms that they were relatively close to where we're based, but that was less important on the property side. It was the franchising that was quite important there, and both of them were substantially franchise based.
Brilliant. Thanks, Louise. The second sort of pre-submitted question, I'll just read it out, so forgive me. So you have frequently mentioned the potential tailwind from increased regulation like the Renters Reform Bill. Rightmove recently mentioned they're seeing a shift from small landlords to larger professional companies. I'm assuming you're more geared towards the smaller landlords than the larger ones. Therefore, doesn't this mean that increased regulation could end up being a headwind for Belvoir instead of a tailwind? As a follow-up, can you provide some details regarding the typical landlord that works with Belvoir in terms of how many properties they own? A typical landlord of Belvoir is the easiest one, anywhere between 1 and 10 properties. Very few of our franchisees like to work with larger landlords for lots of reasons. They don't want to pay agents' fees in some cases. They want a discount, so it's not profitable. And if you deal with a landlord with 50 properties, it can be a threat to a small franchise business when they're turning over about 300,000 a year. So it's kind of between 1 and 10. The typical landlord in the UK, I mentioned this earlier, owns one, or the average number of properties owned by a landlord in the UK is 1.8. So the sector consists of small landlords. There aren't that many sort of large landlords in the sector. Will that become a headwind rather than a tailwind? I disagree. I think there are 160 rules and bits of legislation that a landlord needs to follow to correctly manage a property. And I personally think that a lot of landlords who aren't using an agent are just ignoring the legislation. It's as straightforward as that. Government feels the same. There's cross-party support for tighter regulation of property management. So I think it's the opposite. I think that more landlords, partially as a result of the Renters Reform Bill, which is due for its second reading at some point in the next few weeks. I think partially due to these regulations, the more landlords will say, look, for the sake of how much you cost, which isn't very much, can you just look after the property for me and all of the headache that comes with it? And that's what we're good at. So David D said that some companies are building to let. Will this affect the company? I think I covered that one by saying build to rent is still relatively small. It's about 250,000 units either completed or in the pipeline. If my numbers are right, I think build to rent completions are still sub 100,000. So it's a relatively small part, but necessary over time. David D asks again, and this is quite a common question, it appears that many small landlords are selling off their rental properties due to new regulations. Is this affecting the company in the number of available rental properties? It hasn't affected our portfolio. We've still got growth on as far as our rental portfolio is concerned. And if you look at the size of our managed book over time, we're not seeing any evidence of a mass exodus. So just to use your wording, many small landlords are selling. Some of them will, and I suggest it's the highly geared landlords who are frustrated with higher borrowing costs. If you're a landlord with 20 to 30 properties, not one of our clients, with very high sort of gearing, I'm not surprised that you're looking to sell off some properties to rebalance your portfolio. But as I say, we tend to deal with smaller landlords who, if mortgage rates do change, we feel that are reasonably well placed to weather that storm. And rates obviously have changed. David D again, I'm just doing this in order. Really pleased to increase the dividend. I suspect that will positively affect the share price. It has, I think, a bit today, so thank you. Another question is, how do we find that integrating new mortgage brokers with the Belvoir brand works? I'm assuming there is a big feed of potential property buyers. That's actually still a work in progress. And although there isn't a slide in this particular deck, I would hope that when we next do the next round of presentations, that we'll include a slide to explain the tech solution that we're currently working on in partnership with MAB to help us extract mortgage business from our brand of our network of property agents. So that's a work in progress, David, but that's a seriously good opportunity for us in the future. John H says good management over, I need to read this one out, John. Good management over this period. Thank you very much. I'll pass that one on. John H again, my question is, what is the current interest rate charged to franchisees for the assisted acquisitions? And this one for Louise. Yeah, and if the rate is a lot greater than the Bank of England's rate, would this deter franchisees from making further acquisitions due to the high interest?
So we for most of the time I've been at Belvoir since 2014, we've charged 8.45 over base, and obviously base has been pretty low during that period. But when we started to see the base rate increasing, we didn't want our franchise owners to be deterred from doing assisted acquisitions, or to make the assisted acquisitions more challenging for them by having a high financing cost from us. So it's a discretionary, they're still signing up to 8.45 over base, but our discretion, we're capping it off at 10.7%. So we've still got some headroom between what the base rate is and what they would pay, but it's a lot less than they would pay if they were getting it from a third party. And obviously that is purely because we just do not want franchisees deterred from making those acquisitions.
Just to tag another question onto that, Louise, somebody else has said, you advance 23% of the total consideration for franchisee acquisitions in H1. Is this a typical percentage? Would we like it to be more or less? And where else are franchisees going for funding?
Yes, it's interesting because it is higher than it is higher than it was, in the years, the previous years, including the years pre-COVID, where it got down to around 9 or 10%. And that's because we were helping franchisees access alternative funding sources. Of course, with our rate kind of being capped at 10.7, it's more attractive to them to take what we will lend to them than to take the money from elsewhere. And for us, it's a bit of a balancing act because we want to make sure that, we're not, exposed too much. With the way we say to franchisees, we are prepared to lend up to 50%, but in the main, it's coming out of an average of 23. Some franchisees have, got successful businesses and they've got their own supply of cash to fund these acquisitions, and they don't need to go out for lending, and some of them are accessing lending elsewhere. But we would not want the lending issue, within reason, we would not want it to stall people from doing the assisted acquisitions.
Brilliant. While I do a couple of questions, if you can maybe have a look at a question from Haristo, Louise, just while I'm sort of doing these two. So Alistair asks, you're a franchisor in property, so a franchisor, and increasingly a franchisee in financial services. Why the different approaches? I mean, it's a good question. I think there are a few parts to the answer. I think one, it suits us. It's less risky. We like the Mortgage Advice Bureau concept. We believe that we get good value from our relationship with Mortgage Advice Bureau, and a lot of our mortgage advisors just love the MAB brand. It helps them sell products to clients. It is a strong brand, and I think that really is at the crux of it. MAB have been very supportive with sort of our growth strategy. If the alternative is that we do something and we become directly authorised and we have our own sort of system, when we sort of I'm not saying we'd never consider that. We the mortgage advisors are our advisors, and we choose to contract with MAB. And if we choose to contract with them, it means that we could, in theory, choose to do something different in the future. We have a long-term contract with MAB, and as a board, we're just 100% happy with the relationship. So I think just different businesses require a different approach. Is the sort of short answer. Sam has asked, what do we charge for managed services to landlords? What does this cover, and how does that compare in terms of other providers? I won't go into too much detail, Sam, because we can talk quite a lot about property management, but I'm happy to talk separately. But in general terms, franchisees charge between 10 and 12% per month to manage a property. Now, there are two different ways of charging, ways agents charge in the UK. You've got within the M25 and you've got outside. So within the M25, agents typically charge a much higher fee up front and a much lower fee for property management. We tend to use the outside of London model, which is to charge a very low setup fee and a higher management fee. We just find that kind of works for us and works for landlords. So 10 to 12% tax deductible, and it's pretty much a turnkey service, so a landlord can hand the keys across, and we will deal with maintenance. We'll deal with a tenant who calls at 3 o'clock in the morning, and we'll deal with pretty much everything in terms of property management. I'm a landlord, Sam, and I think if you're a small landlord with one property, let's say, and you haven't been through a scenario where your tenants stop paying the rent, or a tenant's become particularly difficult over maintenance, or you can't get maintenance contractors to do jobs on properties because maintenance contractors are generally stacked out with work at the moment. If you've not been through any difficult scenarios, you probably wouldn't appreciate the sort of the strength of having an agent sitting between you and your tenant, especially if your tenant doesn't pay the rent. If your tenant doesn't pay the rent on a property, they're not going to answer calls from a private landlord who calls to say, would you mind? But in terms of where do you go if a tenant doesn't pay? Again, that's where your agent sort of steps in and deals with the technical side of that. So I think we do a good job for a relatively small amount of money, and some landlords are agree with that, some landlords disagree. About half of landlords use an agent and about half don't use an agent. But as I said earlier, government's very keen to see that the half of all landlords who don't use an agent, they're keen for those landlords to operate correctly. And I suspect that some of them over time will sort of migrate across to agents. Scott has asked, is there a limit to the size of the franchise loan book that we're comfortable with? It's actually been quite a lot higher, isn't it, Louise, than it is at the moment? I mean, we originally raised money on the market many years ago to provide loans for franchisees. It's been as high as 5 million. So we've got, plenty of headroom. And no, I think, if we would happily sort of give loans to franchisees within our sort of lending criteria if they needed it for acquisitions, because it's so profitable for all concerned.
So I'll pick up the question from Histo, which is a really good question. It did have me thinking about it here. So the underlying average returns, I would say that works out around sort of 33%. When I look at the, have to exclude the most two recent ones, obviously, because I haven't contributed yet. But if I look at where we were last year and do a bit of an adjustment for full year at the time acquisition, I would say that against what we'd invested in them, what we bought them at, we're getting a 33% return, and certainly based on the two we've acquired this year, I think that will continue. And the other part of the question was how they were leveraged. I think all of the acquisitions that we've done on financial services have been acquired from cash. Well, obviously, originally bank debt, I guess, on Brook probably bank debt, but mostly cash. So they're no, actually, I'd say even Brook, I think, was cash in. Yes, Brook was cash as well. They've all been cash. And then the underlying growth rate. So it's always quite difficult because businesses have come on at different times. But looking back at Brook, I would say that Brook is 3 times, its profitability is up 3 times since 2017. And certainly the number of advisors has doubled. On the acquisition that we made in 2018 of Mab Gloucester, that's actually the number of advisors have pretty much doubled, and in terms of their contribution, that's probably up by 2.5 times. So the underlying, the organic, if you like, growth in those businesses has been quite substantial. It's not all growth on the financial services from acquisitions at all.
Brilliant, thanks, Louise. And if you wouldn't mind taking a look at the one from Mark while I do this one, that'd be great. So this is from Michael. So if we have the choice of acquisitions in both property and in financial services at differing gross profit percentages, which division will add a greater absolute level of cash profit? I.e., should you be favouring acquisitions in one division over the other? I think it's an interesting one. I think we on the property side, there aren't that many property franchise networks to acquire, good quality ones. So I'm afraid that we just don't really have the luxury of sort of picking from lots of other franchise networks. However, I mean, we are, after doing 139 franchisee acquisitions and 12 corporate acquisitions in our sector, we are recognised as being a good buyer of businesses. So we do get to hear about businesses if networks are looking to sell. So given the choice, I mean, we're very passionate about franchising. We'll do more franchise acquisitions if we can, but there just aren't many of them to choose from. And I think on the FS side, as we mentioned earlier, we've been a little bit opportunistic this year. We did say we would be at the start of the year because we think it's a good use of cash, and at the multiples that we bought them at, as I mentioned earlier, why wouldn't we? So there's just not to be too clear on that, Michael. There just isn't. We just don't have the luxury of a list on both sides to kind of pick or choose from. But I think, personally, I would like to be sort of acquiring more property franchise networks, but they're pretty tough to get a hold of. And at the moment, we've had opportunities on the FS side, if that helps. Haristo just wanted to thank us for the answer to the question, Louise. That's one for you. All the thanks go to you. And then, do you want to have the last one, Louise? That's from Mark.
Yeah, the one return on capital employed. I guess we don't. I wouldn't say it's a big measure of profitability for us. I wouldn't say it's something we track diligently. It's we don't need to employ much capital other than when we do make specific acquisitions, and certainly in terms of it's tracking around 25-26%, but which seems quite a sensible return from our viewpoint, but it isn't something that we track diligently, I wouldn't say.
That's great. Dorian, Louise, thank you very much indeed. You, in fact, answered every question submitted from investors this afternoon, and thank you to you all for your very kind engagement. Dorian, I know investor feedback, and Louise, I know investor feedback is particularly important to you both, and I'll shortly redirect those on the call to give you their thoughts and expectations. But I wondered, before doing so, if I may, Dorian, just come back to you for a few closing comments.
Yeah, absolutely. I think thank you for that, Mark. I think just to say, sort of looking forward. So at some point over the next 12 months, the property sales market will start to improve, and I imagine that will be when Bank of England rate tops out. So we will start to see some improvement on the property sales side at some point in the next 12 months. I think similar on the mortgage side. Over the last 12 months, if you look at the challenges that we faced and all mortgage businesses have faced over the last 12 months, it's been pretty tough. 14 interest rate rises, and we had the mini budget, etc. And what we've continued to do is grow out our network of advisors. So again, when the mortgage market starts to improve, which I suspect it will over the next 12 months, we are sort of perfectly placed to with a good springboard for growth. And then finally, on the letting side, I don't want to say that we've got sort of growth baked in going forward, but I think anybody who's following the sector will see 13 million people need somewhere to live. We're currently looking after 75,000 properties, and that number continues to grow by acquisition on behalf of the franchisees, and we will, as a business, continue to support them to do that.
That's great. Dorian, Louise, thank you once again for your time this afternoon and for updating investors. Could I please ask investors not to close this session, as we'll automatically redirect you for the opportunity to provide your feedback in order that the company can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Belvoir PLC, I would like to thank you for attending this afternoon's presentation, and good afternoon to you all.